All right, everyone. Welcome back to the weekly recap of On the Margin. I'm your co-host, Michael Ippolito. I'm joined, as always, by my debonair co-host, Tyler Neville.
Debonair this week.
You got a new adjective this week.
I'll take
you
that.
It. You had a big week. You earned it.
Better
There's
than
a lot of good content coming out of you this week. Yeah. So you get debonair this week.
Love that. I feel very sophisticated.
Yeah. Well, keep it up, buddy. We got a lot of interesting stuff to talk about this week. Just as a general overview, on our last episode, we really focused a lot on, there wasn't a lot going on in the macro world, and we really kind of honed in on some of the developments in crypto. This week, it's almost the opposite. Lots of developments in macro land. We're going to be talking about this blow up at Archegos Capital Management. We're going to be talking about Biden's infrastructure plan and the move up in the dollar. And then we're going to spend some time on Visa settling transactions in USDC. And then finally, we are going to close it out with Morgan Stanley, Goldman, moving further into Bitcoin. So a lot of interesting ground to cover this week.
For sure.
On the Archegos stuff, there was some great competing narratives out there. Ben Hunt, our friend over at Epsilon Theory, he had some strong opinions on this.
Oh, yes.
Yeah. Probably one of the best titles for a blog post I've read in recent years. Tiger can't change its stripes. Just, wow, chef's kiss. That's excellent. Okay, man, let's get into it with Archegos here. You want to give us kind of just an overview of what happened, who Bill Wang is, what this fund represents, and like what's just going on? Why are we all hearing so much about Archegos?
Yeah, Archegos. That's what Carson Block calls it, and I am using him as the expert in everything Archegos because this thing goes so deep. It goes so deep. Anyway, basically what happened was this guy Bill Huang levered up his fund, his family office, 5 to 10x. You know, people think it was 10 billion levered 10 times to $100 billion in exposure. And one of a couple things probably happened, no one really knows, and basically got a margin call and had to liquidate a lot of their positions. That's the headline story. I think this thing goes so deep, it's disgusting. But we can talk about that. I tend to lean on the Ben Hunt side of things where, you know, you see insane leverage like this. That's not just one person levering his fund. Like there are, you know, many people involved to allow this. So what's your read?
All right, let's give a little background. Let's set the stage. And I think the reason why this is so interesting is because there are very competing narratives about it. And there's what I'll call the Ben Hunt perspective, which I tend to agree with you on. I lean more that way. And then there's the Aaron Brown perspective. And the Ben Hunt perspective is this is a disgrace, right? There was some really bad behavior here. This thing goes deep. It is disgusting. It is everything that is wrong with the hedge fund industry. Then there's the Aaron Brown perspective, which Aaron Brown used to be the chief risk management officer, I think at AQR, so a very large hedge fund. And his perspective is, look, guys, this was some poor risk management from our boy Billy the Kid, but overall, nothing seriously wrong going on here. But let's set the scene with who this guy is, right? So Bill Wang, he's a tiger cub, right? So he's one of these kind of luminary hedge fund managers that used to work with Julian Robertson back at Tiger. After Tiger famously closed back in 2000 after the dot-com bubble, he set up this hedge fund called Tiger Asia, I believe is the name.
Yeah. It was an arm of Tiger, yeah.
Arm of Tiger, okay. We ran it for about 12 years. It was seeded by Julian Robertson, doing very well. But in 2012, he got hit with criminal charges by the SEC, had to shut down his hedge fund, turn it into a family office, pay $60 million. Very Steve Cohen-esque, kind of the result there. Or the guy from Billions, Bobby Axelrod style. So, you know, fast forward till now, he's running a family office. He's running about $10 billion, which is largely, from my understanding, his personal net worth, right? Which, that's just a stunning element. That's basically got wiped out. That's one of the greatest destructions of wealth in the shortest periods of time. So whatever you think about this guy, I mean, you know, there are only probably 200 people on the planet that can even understand what it's like to lose that much money because no one has that much money. So that's another part of the story.
And then, so those two juxtapositions of the story, where the AQR guy, you know, he's so mainstream. Like, what a great read. It was a margin call. You know, like, you don't get $50 billion in leverage and no one's asking any questions. That doesn't just happen. And you know what? The market has been relatively, there's been no contagion from this yet. So it's isolated. But, they all thought like Bernie Madoff was isolated and Lehman was isolated. It's showing that there's so much free money, that there's so much leverage in the system that Goldman had to offer them a massive credit line. Nomura had to offer it. Credit Suisse had to offer it. Because they make so much money from these financing things that you actually need to compete with your competitors. So it's a sign that the whole system is leveraged in one way or another, right? The key is this isolated, or is this, also elsewhere out there? And we're seeing, like, we're adding up a couple more of these things. The green cell thing in the UK, Credit Suisse has been involved in. We're seeing, just a lot of funny stuff going on, which I call smoke right now, because it's not fire, but like when they start adding up, you're like, oh my God, what is going on here?
Having trouble seeing through all the smoke. Well, the other interesting thing is talk a little bit about the arrangement that Bill Wang had with these prime brokers, the way he was getting exposure, right? Because it's not like he actually went out and bought these positions. He actually had total return swaps. So explain a little bit about how that product, what is that product, and how did it allow Bill to get the leverage that he did?
Yes. So it basically is essentially just an agreement between you and the broker. You have an ISDA, right? Which basically gives you the ability to borrow money from them on the cheap, and they give you leverage. So you hold that position on Goldman's books, on Morgan's books, on Nomura's books, and you don't hold it on your balance sheet at Archegos. So if you go look at the holders of GSX. And this one is why I think Bill Huang is fishy. If it happened just in Viacom and just in a couple other ones, but he owned like dog shit companies.
What do you really think, Tyler? You always sugarcoat it. I can never get to what you actually really think.
Yeah, sorry. But so this GSX thing, Carson Block and literally probably 7 or 8 short sellers, and even the whole Chinese retail crowd basically all knows this thing's an actual fraud. Like it's 70% of its user base is fake, 90% of its revenues are fake. There's 7 or 8 really reliable short sellers have come out, published on this thing saying, like, I don't know why it's going up. Like it's so weird. Turns out that Bill Huang and his compadres from Tongyue and other Chinese hedge funds or family offices basically choked the float of this specific stock. And it skyrocketed like 4x from $30 to like $120. Caused that gamma squeeze effect that we're seeing in GameStop as well. So it was a complete stock manipulation trick. So where they get the leverage is, and this is inconspicuous, is they get it from all these brokers. If you look at the holder base, it doesn't even show that he owned any of it, which shows you that all these brokers are complicit in this thing. They gave a fraudulent company that like $30 billion of valuation. And Carson said, at best, it's immoral. At worst, it's really illegal. And so that's where I stand on it. If it was other stocks, bigger stocks, we probably wouldn't be talking about this. But GSX is like a fraud. And this guy is preaching like Christianity and, externally, he's got all the signs of a sociopath con artist, which kind of Bernie Madoff did too, right? So that's where, the Aaron guy from AQR, that's such a bread and butter. Like, come on, dude. You think in this day and age where $50 billion, it's like, oh, it was just a little margin call. Like, you're so institutionalized. I'm sorry. He's also talking his own book because he's like a systematic guy.
Well, so there you go. So the reason we brought up that history of Bill Wang, right, in his, let's call them run-ins with the SEC and I think the DOJ as well, is that this agreement that he had with his prime brokers, if he had actually gone out and held these stocks on his book, he would be subject to more regulatory oversight. But the fact that what he actually owned was a contract with, Morgan Stanley, Goldman, Credit Suisse, Nomura, that's all the regulators see on his books, right? So what the allegation is, what Ben Hunt kind of hints at, is that, okay, this agreement that he entered into, this way of gaining exposure, actually allowed him less regulatory oversight, which on its own isn't necessarily suspicious. But when you look at what he was investing in, some of his prior investment strategies and what he's been indicted for in the past, doesn't paint such a good picture. Now, the other thing is you kind of gave bunny ears on this margin call. So let's talk about that, because the other implication here, what is kind of being whispered about, is that the big no-no that Bill Wang committed was he pledged the same collateral to fund trades at multiple different prime brokers, right? So one of the reasons, so Goldman, they were the first one to begin selling and liquidating positions, and there's speculation because they realized this essentially, that the collateral that Archegos had pledged to them was actually pledged to multiple other prime brokers as well, which obviously would be very worrisome. So there's that whole dynamic to this as well.
Yeah.
And that would be just fraud, right? If that was actually the case.
I think it's just an institutional failure. The irony of these giant firms like Goldman and Morgan and Nomura is they have ultimate compliance at the lower levels. But when it gets to the upper level, it's probably like, oh, Bill Huang, check the box. He's good for 50 billion. And I joked around in one of my newsletters this week where it's like, I just refinanced my house. That was a full cavity search. We have people coming, and it wasn't even that much. It's, comparatively, it's not even that risky. And I'm doing like 3 weeks of paperwork, and they're giving me like, here's my paychecks, and someone's coming to my house today as a notary, and Bill Wang just gets here's 50 billion, how, this should be a national story about how imbalanced society is. And I actually think it's a seminal turning point from that capital to labor type thing where, we're not playing on the same playing fields, and everybody knows it. And it's that this is one of those moments where you go, okay, I will remember this, and that's going to be a reason why the pendulum starts swinging the other way.
Yeah. The other dynamic that I think is interesting here is there was some agreement between the primes kind of figured out that this was all a problem, right? And they all kind of got together. So it was Goldman, Morgan Stanley, Credit Suisse, and Nomura. And it seems like they basically had an agreement that they weren't going to immediately start selling this collateral, right? Because that would be damaging to all of them. Then Goldman, in classic Goldman fashion, just said, no, actually, I'm going to go ahead and sell that. I guess maybe this is an outsider's perspective looking in. Why does Goldman have the trust that it does? There are just so many instances of them doing things like this.
Yeah. On one side, you could say they risk managed this incredibly well. Here's a great inside scoop. This is hilarious. So I worked at KBW, it was a small investment bank in 2007. And they had a meeting where JP Morgan guys, who were these cool, like mortgage-backed security guys, came in, and they were like, hey, we got a deal for you guys. We're going to give you these mortgage-backed securities at a discount. We'll sell them off to you. You guys can buy a little piece of them. Then you sell it off to your friends at a bid, higher bid. This is the stuff that happens behind the scenes at these banks when they have too much exposure in an area and it starts going bad, right? Except that one was levered 30x. Subprime was, those banks were levered even more. But they all sell, they'll keep selling dog shit to the public. I mean, this GSX thing is amazing. It's a $30 billion fraud that was literally gave value to it by a daisy chain of messed up incentives and like beating earnings and all this other stuff. I would love to know what percentage of earnings Bill Huang was for these banks. But yeah, inside scoop is, they all are competing against each other, but they're all in it together. They glom on to like a narrative. And what I think is equity financing is because they don't make money on commissions anymore. And this is a little bit, tell me if I'm going down a rabbit hole. Commissions went from 5 cents a share to like 0.5 cents a share, depending on how you execute it. And these guys used to make so much money off commissions, it didn't matter. Now they make money off total return swaps. It's basically, it's equity financing where you lend, you own the stuff on your books and you basically charge someone an interest rate. And if you do that on super leverage, that money adds up to like a good chunk of earnings. So they're basically making up a lot of those commissions by doing this stuff on their balance sheets now. And I think that's the real canary in the coal mine, is that the business is shrinking. And this is what we talk about all the time, the movement from legacy finance to digital assets, is anytime you get pricing power that's dropping and your commissions are falling, fees on the buy side are falling, it's the markets are eating the world type philosophy.
Structural decline.
Yeah. So you always it's an arbitrage. You bet against stuff that's commoditized, and if there's a premium, Coinbase, look at Coinbase, profitable, trading at $117 billion, valuation on FTX. That money finds its way to things that have pricing power and innovations and growth. And I think this whole leverage thing is just the beginning. It's the smoke that we're seeing from these brokerages that are kind of dying. Like they're making money off SPACs, IPOs. The IPOs should drive it, really, but it's not making up for all the death of the rest of the business.
Yeah, absolutely.
No,
that was great. And honestly, these banks aren't making much money on Bill Wang anymore. Actually, the figure that I saw in that Bloomberg article was that looks like Credit Suisse and Nomura are on the real losing end of this trade, and they might be facing losses of up to $2 billion undisclosed. Mm-hmm. But that is not chump change even for them. That's pretty significant. So
yeah, it was like 2 years of profit or something for Credit Suisse.
Yeah, that sucks. Honestly, though, the biggest, we talked about this a little bit at the opening of this. I am not feeling sorry for Bill Wang at all here. But man, to go from $10 billion and basically have that all wiped out in the span of a month, how? Dude. What? How do you wake up? What do you wake up? You wake up, you're a billionaire. You don't have to worry about money for the rest of your life. You're king of the world. The government probably lets you in. Yeah.
But here's the thing. This is why I think it's so fishy, is like, it's screaming at you. This is one of those things that doesn't pass the sniff test. This guy was preaching like super Christianity while levering his fund up and lost the most money. That is a degenerate gambler's mentality. That is not an uber Christian mentality where it's like conservatism and all this other stuff. Like, I love the extremes of society because it usually shows like the most giant hypocrisy, and it makes the best movies, and it's like, but that is the perfect sign. Like, this guy externally preached all this stuff, but levered his fund up. That's sociopathic. Like, I'm not a therapist or a psychologist, but come on. Why would you be doing that if you were worth 10 billion? It makes 0 sense. It doesn't pass the sniff test.
Yeah, it doesn't look great. Look great. No. All right. I think Bill Wang's had enough from us. Maybe we'll be getting a call. Maybe he watches this. All right, let's move on to Biden's infrastructure plan and kind of some movement to the upside on the dollar. Let's just go over really quick the infrastructure plan because it's kind of interesting what's actually in there. So it gets billed as a $2 trillion infrastructure plan to rebuild the aging roads, bridges, rail lines, other foundations of the economy. Biden has called it a once-in-a-generation investment in America. To give everyone some sense of the scale that we're talking here, the plan would aim to rebuild 20,000 miles of road, 10,000 bridges. It's pretty incredible. And I think we need it, actually. The U.S., we currently rank 13th in terms of infrastructure, which when you consider how wealthy we are as a country, that those numbers don't look great. The way that this is going to get paid for is a hike in corporate tax rates. Looks like it's going to go from 21% to 28%. And even though the bulk of this spending of the $2 trillion would occur over the next 8 years, it would actually take about 15 based on current estimates to recoup our investment. What are your thoughts overall on the infrastructure plan?
I like it. It presents a fiscal problem. The deficit grows larger, but I guess it's a game theory thing. What are you going to do? I think we probably should have been doing this stuff for the past 10 years more so. but we had monetary policy holding the reins instead of fiscal. But yeah, we need government to incentivize, I think, these types of things, high capital expenditures. I used to think free markets would take care of it, and entrepreneurs would just basically create the technologies that help that stuff. And some are, but on the whole, I think if you just let the free market work, and it just goes towards consumerism because it's the easiest, lowest common denominator to build a scalable company. So I'm for the infrastructure plan. I hope they use the money wisely.
Me too.
And I don't know. What's your read on if this happens forever? Does money just get handed out? Like, what do you view? More and more of this infrastructure plan stuff.
I do. I view it as I think this has been outlined by a bunch of different people at this point, but I think we're seeing a transition from monetary to fiscal, and then in the beginning it's kind of central banks, QE, base money printing, that kind of stuff that doesn't get money out into the broad money supply, right? So we've seen inflation in financial assets. This is kind of the next step. This is where you involve fiscal and actual government spending, and that probably does get real money out there. And then the final version of this would be some version of MMT, which I think they're already starting to tease at with the stimulus. And I think what a lot of people miss is if you don't think about precedent when it comes to government policy, like there's nothing so permanent as a temporary government policy. And not to be a total nerd, but if you go all the way back to Roman times, right, Caesar, the big thing that he did, if you heard that phrase, he crossing the Rubicon, the arrangement back in Roman times was that there were these generals, they commanded large armies, they never ever brought them across this river, the Rubicon. If you did, it was an overt act of war. Caesar did that, he crossed the Rubicon, he became the dictator. What people don't know is that he was actually not the first guy to do that. There was a guy before him, his name was Sulla, he did the same thing. Actually, he brought armies across the Rubicon. He did these horrible things. He called them proscriptions. He killed about 40,000 people. But then he actually gave power back. He gave the power back to the Senate. The problem is the next guy doesn't give the power back, and he set the precedent that this is possible. So the problem is not $1,400 stimulus checks or $2,000 stimulus check, but we've already crossed the Rubicon. It's already happened. They've already laid the infrastructure to start giving people money. People are going to start expecting this stuff. I think it's already happening, and I'm not even sure that it shouldn't happen, because there does need to be some leveling of the playing field. There does need to be some deleveraging of the system. So I kind of just think it's going to happen at this point. I guess that's my view. I don't know if that's good or bad, but it feels like we're on the road.
Yeah, I think it's almost a bipartisan thing at this joint, because it's like, I just think in 10 years we're going to look back and we'll probably say, man, we should have stopped that, but for now, you have low interest rates, you can take advantage of it. The dollar hasn't gotten torched. In fact, and this is where, leading into the dollar story, I think every time the yen, the yuan, and the euro weaken against the dollar, that gives our fiscal authorities an amazing amount of firepower to just, I'm going to issue as much debt as possible, and it's not affecting the dollar. It's not affecting our trade. We actually want our dollar weaker, in fact, because that means we can export more and growth goes higher. So I think we'll just see more and more of these come through. Like, I actually am losing track of them because, first it was a $4 trillion infrastructure plan. This one's $2 trillion. He also is going to do another $2 trillion for, the pandemic. So I'm losing track. I mean, it's upwards of 10 trillion since last year, I think. Mm-hmm. And the dollar hasn't imploded just yet. I think it will. My call on Thursday's newsletter is the dollar will roll here, I think, in the next couple of weeks, because we're at extremes in the yen, the yuan, and the euro.
Yeah, absolutely. So yeah, talk a little bit about that. What were the implications of a stronger dollar?
I think stronger dollar, Jim Rickards talked about this like years ago in this book called Currency Wars. So as growth rates drop, your national growth rates drop, you end up, and there's no new technologies that are picking up the reins of growth internally in these economies, you actually end up trying to steal growth from each other using your exchange rates. So if the dollar goes up, that creates deflationary pressures, and oil and gold and all the old school commodities. If the dollar goes down, that creates like the old school inflation. Vice versa, if you're the Chinese yuan, that's been strengthening from 2020, which causes a weaker dollar, which is why we saw the inflation narrative pick up. The past couple weeks, the yuan has weakened, caused the dollar strength, and kind of taken some deflationary or created some deflationary pressures. I still think we're in the inflationary environment, but it's all this game between push and pull between the biggest economies in the world.
So there's almost this trade-off, right, in between kind of exporting power, so health of that core manufacturing sector, and on the other side, you're risking inflation and asset bubbles. And it seems like what the world, every single country in the world is saying is, we want a weaker currency, and we will gladly take those asset bubbles and inflation because nobody wants deflation right now, is what it seems like. Is that an accurate view in your statement?
Yeah, and that's the fascinating part is we are all relatively, the fiat currencies are relatively traded against each other. But if you price them in Bitcoin, it shows up, the inflation shows up really quick, right?
It does, yeah.
And that's what's fascinating. And I think the labor pools of every economy haven't really called BS on the financial games that the governments are playing, which I think they're starting to. $15 minimum wage is getting kicked in. We're starting to see labor unionize, like those types of things are happening, which I don't know is a good thing in some senses. I'm just afraid it goes too far down the line.
Totally. And to your point, I mean, one thing, when you think about labor unions, you kind of think of unions that support manufacturing, right? Because that's kind of where they first really sprung up in the United States, I think back in the 30s. But now if you look at the core composition of the S&P, if you look at the top 10 companies, that makes up 50% of the S&P 500. And it's, it's Facebook and it's Google and it's Amazon. And you start to think to yourself, well, I mean, it is interesting. Amazon just came out and said $15 minimum wage, right? And, you could be altruistic about or have an optimistic sort of view. But I think Jeff Bezos is a pretty shrewd, smart guy. And what he's worried about is unionization, because you saw, people hints about that at Google, not in any real significant way, but man, if some form of unions came to these tech companies that are really egregiously taking advantage of labor conditions, if you look at like Uber and Lyft and this whole gig economy thing, man, that would be wild, wouldn't it? That'd be a whole new dynamic in the labor to capital shift.
Yeah, and what happens to those stocks? That's
nothing good. Nothing good.
And that's where I'm at, where I'm, if that labor to capital thing really happens, I think you had the valuations of all those companies just overshot, thinking everything was going to remain the same. And I think that's the biggest understated risk here is like wage inflation and food inflation causing the workforce to basically say, hey, you need to pay me more. And that's going to happen no matter you like it or not. You kind of took advantage of of us for 10 years now.
Yeah.
So
no more. Enough of that.
Yeah.
All right, let's move into crypto and Bitcoin for a second here. So Morgan Stanley and Goldman both moving further into Bitcoin. A couple of details here. So basically, Morgan Stanley said in a regulatory filing released on Thursday that 12 of its institutional funds may gain exposure to Bitcoin either through cash-settled future or through GBTC. The list of funds includes Counterpoint Global, which is a $150 billion fund overseen by Dennis Lynch, which Blockworks reported on back in February. I guess this shouldn't really be a surprise because last month Morgan Stanley revealed that they would begin offering some form of exposure to Bitcoin to its wealthiest clients. I guess let's get through. So Goldman is doing something very similar, right? They're also offering a form of exposure to Bitcoin. They're potentially rolling it out in Q2. I think it's a little bit more interesting because they're offering potentially physical Bitcoin exposure, derivatives, or traditional investment vehicles. I'm very torn about this because on the one hand, there's obviously, if you'd asked me a year ago, how big would it be if Morgan Stanley and Goldman were offering Bitcoin? oh my God, I can't believe, that'd be huge, right? That'd be the biggest news. And I'm kind of surprising myself because I'm just struggling to care that much about this. I guess my deep emotion is just, well, yeah, duh. Of course, there's money to be made, and they're moving into it. And the products that they're offering are poor. They're not very good. I guess it looks like Goldman might actually offer exposure to spot Bitcoin, but all this stuff, man, like Jeff Dorman pointed out, I guess right now GBTC is trading at a discount, so I guess you kind of should buy it. But exposure to GBTC, if you bought it when you had a premium, you might have missed out on hundreds of percent in return, right? Mm-hmm. And I don't know. I just am I guess my real actual response to this is I'm struggling to care that much that these banks are involved.
Yeah. On one hand, it's pretty incredible. Here's what I find so fascinating about Bitcoin is that it's technologically so advanced in so many ways, but like you actually can have an edge on information and you can front run compliance departments, right? Like, so we get this news now and people haven't even started buying it in their accounts yet. So you're kind of like if you buy Bitcoin now, you're kind of front running Goldman clients. And here's a perfect example. It's like when Tesla announced that they bought Bitcoin, I woke up that morning and I was like, okay, I'm buying a Bitcoin. Boom. And you make money. It's like in the public markets, all the algos and high frequency guys, as soon as that hits the tape, everything already moves. And so I find it fascinating. Like this is announced and Bitcoin really didn't have much of a move because I don't know, I guess the money is hard to get into the ecosystem, which it shows that there's gaps in the on-ramps and there's pricing power, right? Mm-hmm. Which makes me even more bullish. So
totally.
But I agree with you. It's kind of like the headline, you're like, whatever. It's this weird, you've seen Mass Mutual, you've seen everybody come into the ecosystem.
Yeah. We're probably a little spoiled. I think we're kind of numb to it right now. Mm-hmm. I think this gets back to, like, you and I have talked about this a lot, I think on air, off the air, but just how is Bitcoin trading right now? Like, what is really driving Bitcoin? And I think the biggest worry that I still have is when I see Bitcoin being correlated to the NASDAQ, I think is the most, I just don't love seeing that, to be honest. Mm-hmm. But I think, when I talked to Lynn Alden a couple of weeks ago, her mental model for this is Bitcoin, the primary driver of Bitcoin price tends to be it's on this 4-year supply cycle, which is anchored around the halvening. And in between, right, in those general up and down movements, it tends to, attach itself a little bit to other markets and there kind of looks like there are these temporary correlations. But at the end of the day, the real input for what's driving its price is this stock to flow kind of supply schedule. So
yeah, I love that outlook.
Me too.
It's so spot on. And you know what? It decoupled a little bit from NASDAQ when NASDAQ was falling and Bitcoin held its value. And I took that as a huge, I called it Divergence Day, like hearkening, Bill Pullman's Independence Day speech. But like that really stands as like a big divergence in my view, where the NASDAQ fell like 3% and Bitcoin was up, I think. Mm-hmm. And that's huge outperformance.
Yeah,
in my opinion.
Now, I'll give the other side of this coin, which is the reason why it's so important that investment banks are getting involved in this space is they will facilitate trust, right? So I think banks offering their, private wealth management clientele exposure to Bitcoin, I don't think that's particularly exciting in one way or another. As we both know, that doesn't even necessarily mean it's an endorsement from the bank. It just means that they think they can make money from it, right? And I guess it means there's at least enough regulatory clarity that they're somewhat comfortable operating in it. But I think what will be really interesting for investment bank is when they actually start to move into the capital markets infrastructure and open trading desks and start providing liquidity. I think when they start doing that, then that will be really interesting. Because there is a place for banks in this space, for sure. In a lot of ways, we're waiting for them. And we have been for a long time. So I think what Goldman and Morgan Stanley are talking about right now, just offering Bitcoin exposure, not very exciting. When they move into the capital markets trading desk side of things, really impactful, I guess is my take.
Yeah, I'm kind of wondering that because having seen these banks operate, they are a cluster of bureaucracy. You need paperwork on paperwork on paperwork just to get more paperwork. And I don't think they'll be able to, like, I think Genesis and NYDIG and all these other companies will crush them. Like, trading is not hard. I traded for 12 years. It's you just need a big balance sheet, and that's what they have, I guess. But like, as the ecosystem keeps growing on its own, like they don't have the technology. They got to build the technology to do it. I don't know. I think you're already up a huge hill, so I don't need. My point being, like, I don't even know if it matters.
Okay, here's an interesting dynamic for you actually, because I think exactly what you just, I think banks assumed for a long time, if this becomes a thing that we need to get involved in, then we can buy our way in, right? We're not going to actually build the technology in-house. We're just going to buy our way in here, right? Buy some incumbent. The Coinbase dynamic is fascinating because the value that the market has assigned Coinbase is much larger than the incumbents. And actually, if anything, it looks like it should be the other way around. And Coinbase should be acquiring CBOE or even CME or whatever.
It's crazy. Yeah.
And I'm wondering if banks are looking and saying, oh my God, the solution that we always thought we had, we might not be able to afford it anymore. And meanwhile, they're getting clobbered by low interest rates, right? Bad time to be a financial. I don't know. I hadn't actually really thought of that until right now, but that's interesting.
I mean, like that. I wrote that thing on blockchain.com the other day where they're just a better run business than all these other banks. And do you know how hard it would be? Like, here's a perfect example. Worked at a giant $1 trillion asset manager. To get a trade settled, sometimes it took like 5 days of like crazy communication between, like, sometimes it would fail, sometimes it wouldn't. And like, that's just stuff that wouldn't happen at blockchain.com or Coinbase or whatever. You just have the technology is built to settle immediately, right? Yeah. And there's so many people. Wells Fargo has like, what was it, 100,000 people? I got to look back at my note, but they have like so many employees. If you were to implement something like this, you would get everybody get their hand in it and screw it up and build it poorly. That's just how they function. They grew too big, and now it's like, David and Goliath, except, Goliath is just this old, giant, lumbering person that you can just take down. It's kind of like, what's a sports team that went and aggregated all the, like, old, aging stars?
You can't be asking me for sports analogies, man. I'm not gonna get you there. I'm not gonna get across the finish line.
It's like watching Shaq in his, in his 30s, where you're like, oh my God, it's Shaq. That's incredible. But then you watch him run up the floor, and you're like, he can barely run. That's how I view like all these companies. Like, you hear Goldman Sachs and you think sure, they make a lot of money, but like, what are they doing that's new besides like bringing in IPOs are going out of style? You can do a direct listing. Like, they must, in the boardrooms, you must sit there and be like, God, what are we going to do in 10 years?
Okay, you want a sports analogy? Here's one. It's like watching Tom Brady trying to run. A big Brady guy, but watching that guy try to move, dude, it's like he's moving in slow motion or in molasses or something. You're like, is this the same frame of motion that everyone else on this field is moving? Like, buddy.
Like, I can run faster than that.
Like, I can run faster than that. Christ almighty. And he's still the GOAT, though. So, all right, we're running low on time, and I actually want to get to this last thing, which, okay, here's an actual significant, impactful announcement that's coming out of crypto. So Visa announced it will now settle payments in USDC on the Ethereum blockchain. This is significant. So here are the details of actually what's going on. Visa is conducting a pilot program with Crypto.com that will allow them to settle payments on their credit cards in USDC. So before this, Crypto.com, they have a credit card program with Visa, had to settle in fiat currency. So basically they're going through conversions, right, which adds a whole bunch of different costs and complexity. And now they're just allowing them to settle in USDC as kind of the base settlement asset, which is huge. Visa settlement agent for USDC is the crypto bank Anchorage. A lot of interesting stuff coming out of Anchorage these days, which means that basically just crypto.com will send USDC to Visa's Ethereum account at Anchorage. And eventually, Visa has said that they plan to allow settlements in CBDCs as well. This is that. See, that is like a core infrastructure, not very sexy thing, which is just like, oh my God. So here's my take on this. Here's why I think this is impactful.
Hit me.
Number one, this is just on-ramps, right? This is a huge on-ramp. Visa's payment network is massive. I don't even know how many merchants they work with, but it's in the millions, or if not tens of millions. I'm going to look this up. I'll probably find it's even more. It's a colossal number of people. Number two, this eliminates a whole ton of frictions for crypto companies. We talked with Rain Steinberg, CEO at Arca, the other day, who's actually working on treasury management for crypto native companies and then manage a huge portion of their treasury in either Bitcoin and Ethereum or USDC like stablecoins. Interfacing with the fiat world when your reserve asset is in crypto is really rough. This is a huge step to be able to settle payments in USDC, which is just a better system, by the way, is really, really impactful, I think. And I don't know, man. I think overall when it comes to payments, like this is kind of the next step, right? I am not one of the people who's like, oh, speculation, that's so bad. Speculation is the mechanism that brings the people in. But eventually we need to get to payments. That was one of the big promises here, right? Mm-hmm. And now it seems like that's actually coming to fruition, which is really, really exciting. And the thing about payments is the reason why when you go to pay, you have like 10 different options. Oh, you want to do Apple Pay, you want to do Venmo, you want to do this credit card, whatever, is because people understand that the more options that you allow people to pay in, the less friction there will be and the more sales will actually happen. Like the game of payments is all about eliminating frictions. And to me, Visa allowing people to settle in USDC is basically a big affirmation that there is a colossal amount of demand for this new economy. Mm-hmm. So like this, not the sexiest thing, but good work, Visa. This is big. This is a big deal. Big deal. Good work.
You know, that's almost one of those moments where, I don't know, Netflix goes from DVDs to just streaming. And if you get it, you know, I think the market hated it at the time where it was like, oh, Netflix is not doing their DVDs shipping anymore. They're going to do this streaming thing. But it's like, oh my God, light bulb moment, everything's going streaming. Mm-hmm. And the market doesn't really care now, but like 5 years down the line, they're going to be like, that's the seminal moment. Like that really changed it. And I think this is one of them too. I mean, I couldn't agree more with you. It's just funny the market doesn't react to that.
I think the market is scarred from these. Back in 2017, there would be these announcements coming out of financial service firms. They'd be like blockchain POC, and everyone in the industry would be like, "Oh my God, this is such bull. It doesn't mean anything, right? Nothing, right? It's a bit of PR." And I think the market is still overall scarred, and that's the knee-jerk reaction. Mm-hmm. But I think if you really started to pay attention, this is changing. Like even if you just like we talked to a lot of financial services firms. And even a year ago, you know, people ask, well, what department are they working in? And there was no department. You were talking to the crypto guy at these banks who was desperately trying to get buy-in from his colleagues or her colleagues about how they can move this stuff forward internally. That's not the case anymore. There are teams. Mm-hmm. This is all happening at the board, you know, C-suite board level. It's changing. And that's something that you don't necessarily see from a public standpoint, but I mean, it's big. It's big.
I couldn't agree more. You know what? Speaking of which, I think we need, and there's a huge demand in this industry, and it's part of the thing that we're trying to cover at Blockworks, but when you get some of these PR people writing like PR releases for the digital asset companies, it's like in Swahili sometimes. And I'm like, what are you trying to say here? Like some weird link between this, you know, crazy altcoin and this other one. And I'm like, tell me why I should care. Like how, maybe, you know what? Reach out to Blockworks. We'll set up a PR. We'll tell you exactly what you're working on as your project in English. Get rid of these. I don't want any more of these PR people hitting me on like, no offense, like I know you provide a service, but like break it down in plain English, you know?
Yeah.
Because you think you're going to translate that to a mass audience. Like, come on. There's some guys that do it really well. And there's a premium for them. But
I agree. This
is huge news. This is huge.
You know who made me laugh actually? Paul Singer on an episode of Grant Williams the other week was like, I'm getting these things about crypto that looks like this Babylonian text. And I completely he's like, these smart people are sending me these Babylonian texts, and I completely hear him on that.
You know what it's like? It's just like you're too close to it, and you forget what it's like outside of that world.
That's exactly right.
And that's probably what I just did with Archegos in the beginning of this interview. It's too close to it.
I think
people understood.
People did.
Yeah.
I think you get really deep into something, you forget what the actual like civilian level of knowledge is. But
yeah.
All right, man, we got to wrap it up. Unfortunately, we didn't even get to talk about your kids, your sleep habits. I feel like these are the things I'm curious about. I just want to make sure you're getting enough sleep.
Yeah,
are you getting enough sleep?
How's the power washing going?
You know what? That power washer was the best purchase I think we ever made. I'm like so happy about this power washer.
You don't work out anymore after work. You just go power wash.
No, I just go power wash the porch. Yeah, just up and down. I got like my noise canceling headphones. I
gotta get you a pair of galoshes to go with those things.
Well, I told you we're in a bit of a battle with the neighbors about the power washing, but we handily won the battle. Yeah, we're 2 weeks in. We might be the victor. Someone's already coming out on top of that little power washing battle. So, be warned. All right, Tyler. As always, this has been a ton of fun. Until next week, my friend. All right.
See you guys.